Overnight in South Korea, we saw that tech giant Samsung came out with a negative pre-announcement regarding their expectations on future profits and sales. It was eerily similar to what we saw here in the United States with Apple last week, so we certainly had the possibility of a negative stock market reaction here today as a result. Instead, traders remained resilient and focused on the more positive tone between the United States and China in regards to the trade situation. We closed higher by over 1% on most market indices, and that was the third straight day higher for the S&P 500. In fact, the NASDAQ and the Russell 2000 actually have 3 green arrow signals for the first time in quite some time. So our trade application example today is going to focus on a small cap NASDAQ related stock. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 8th, 2019. First of all, if you're new to these videos, welcome aboard. We're grateful to have you in our audience today. Remember, you can go to YouTube and subscribe to our YouTube channel. And while you're there, check out our description area so you can sign up for our email distribution list that entitles you to all the stocks in the S&P 500 that are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. Make sure you're following me there. My handle is @BrandonVanZ. And make sure that you're clicking like and retweet on all the market outlook related tweets that David and I post out there if you get value out of these daily videos. In addition to that, we also have a presence on Facebook. Feel free to join us at our group in the web address embedded in the logo in front of you. All right, let's go ahead and dive into the charts now. As you can see, I've got chart 4B pulled up in front of us for those of you that are premium Market Scholars subscribers. And this particular chart setup is basically going to look at the 4 major market indices here in the United States. We've got the S&P 500 in the upper left, Dow Jones upper right, NASDAQ Composite lower left, and the Russell 2000 in the lower right. Each one of these charts is 3 months in length. Each one of the candles is 1 day. And so, as we look at this, just a quick heads up as far as the performance for today. I kind of mentioned it there in the intro, just to make it formal. We were up about 1% on the S&P 500. It was 0.97% to be exact. We were up 1.09% on the Dow Jones. That was led higher by Boeing, among other names. We also saw the NASDAQ had a strong day, as this was more of a risk-on feel to this day. NASDAQ was up 1.08%, and then not to be outdone, the Russell 2000's coming firing back. It was up 1.51% here today. Now you'll notice that the way that this particular charting package is set up here is it kind of revolves around the mindset of the market forecast technical indicator, which is a technical indicator that you can find on a lot of the different programs over at TD Ameritrade and Thinkorswim. And the way that we've got these charts set up is that on the background color of the charts themselves, that will determine whether we have what's known as a bullish posture or a bearish posture using the intermediate term line on the market forecast indicator. The intermediate term line is that green line that you see down below here in this indicator. You can also see the value of that green or intermediate line within the label right here. So as an example, on the S&P 500, that line is currently at 38.85 and rising. Well, if it's between 20 and 80 and it's rising like it is right now, we consider that to be bullish. Now, because it's not above 50, we don't consider that to be strongly bullish. So it is bullish, and that's a first step, and it's good to see, but we would still consider it to be weakly bullish. Of note is that the S&P 500 remains below a falling moving average. Now remember, that has nothing to do with the market forecast indicator itself, but is still important for a lot of technicians out there. We'd like to see some progress above that moving average. As you can see in the past, as we've approached that moving average in the last 3 months, we've typically failed around those levels. And so it is an important level in the current juncture as we kind of have bumped our head just up on the underside of that downtrending 30-day moving average on the S&P 500. But as you see on the other graphs that are up here, first of all, the Dow Jones also has a weekly bullish posture using the intermediate term line, and so does the NASDAQ, and so does the Russell 2000. That's why those background colors are green there. But what I want to kind of distinguish with the NASDAQ and the Russell 2000 as opposed to those other two mega cap indices is notice that we actually have price above a moving average in the case of the NASDAQ composite, and we have price above the moving average in the case of the Russell 2000. So we're seeing a little bit more strength in those two indices, and that is generally viewed as a good sign. It's a more of a risk-on type of market mindset where investors are once again embracing risk as opposed to shying away from it. Remember, when the stock market gets a bit dicey, sometimes it tries to hunker down in some of the mega cap names out there, you know, your Procter & Gamble's and Coca-Cola's of the world. And of course, those are major components within the Dow Jones. When markets feel comfortable enough to take on a bit more risk, they go down the risk chain a bit to some of those more technology-oriented firms in many cases. A lot of your FANG stocks, as an example, in the NASDAQ. So it is a healthy sign to see that the NASDAQ and the Russell are kind of leading us right now. Now, we're not out of the woods. Obviously, you look at those charts just with the naked eye, and you see that we still have a series of lower highs and lower lows. But the fact that we could close above those moving averages is a very good initial sign if we are going to attempt a bottom during this current market environment. So let's go ahead and take a look at our next chart setup now, which will be chart 4C. And this will be our 3 green arrows chart setup. Now, this is what I kind of hinted at the in the intro video. Notice down below here, or the intro of the video, I should say. Notice down below that the comp Q, the NASDAQ composite, it's pulled up on the Thinkorswim platform just using ticker symbol comp. It now has a 3 green arrow signal. Now, for those of you that are not familiar with that parlance, basically the 3 green arrow signal is a way for us to look at 3 different technical indicators and see if they are giving us bullish indications all at the same time. And so the way that we kind of look at this is, first of all, the first of the 3 green arrows is the moving average itself. We need price to be above that moving average in order to generate a green arrow. Well, that's what we were able to achieve today for the NASDAQ. The second one down, or the second arrow that we would focus on, is this MACD. This is the moving average convergence divergence, and this is a histogram view of that MACD. And what we're simply trying to do is get above that 0 line. You'll see this kind of horizontal line going between the green and the red bars that you see here. So if we're above that, we view that as positive momentum for that particular security. And of course, that has been the case for the NASDAQ for really the last 5, 6, 7 sessions here. And then we also look down below here at the stochastics, which gives us a sense of whether markets are trading at the top end of their trading range recently or at the bottom end. And it's generally perceived to be a more bullish sign if we're closing near the highs of various trading ranges. And that is what we've been able to achieve here with the NASDAQ recently. So we do have what's known as a phantom green arrow in place here with the NASDAQ composite. So that's a positive sign. We also see over here, the Russell 2000 is basically showing us kind of the same indications. We've got green arrow number 1, green arrow number 2, and green arrow number 3. Notice the green background color on both of those charts here on chart 4C is helping our eyes easily distinguish that. Now, before we get overly excited about that, I will remind you that there have been plenty of times in the past where 3 green arrows ultimately fail. So we've got to be cautious around that mindset. You'll notice that back here, we had a 3 green arrow setup, and back here, we had a 3 green arrow setup. In both of those cases, those setups failed. And so just because we're getting it right now does not guarantee any sort of a launch higher or anything along those lines. It's just a starting point. If the market is to ultimately rise significantly in the future, it will start with a 3 green arrow signal of some sort. So could this be the one? Perhaps. We get new information from the marketplace every single day, and that's why David and I come to you to give you the rundown on the charts here the way that we do, so that way we don't miss the beat too much. Now remember, technical analysis is always using lagging information, so we'll never be able to predict the future perfectly. But what we're trying to do is examine the data from the past to help us drive an expectation of sorts of the future. So at this point, that's a healthy sign. We still don't have 3 green arrows up here on the S&P 500 or on the Dow Jones. And so we'll keep our eye on that. If the stock market remains resilient throughout the rest of this week, remember we've got a big speech from Trump coming up, so perhaps that will get traders excited. On the other hand, maybe markets sell off as a result. This is a very much a news-driven market environment that we find ourselves in. But if we do get a strong upward move here throughout the rest of this week, I would anticipate that we'll get some 3 green arrow signals out of the Dow and the S&P 500 as well. Let's go ahead and take a look at our next chart setup here. This is our 1040 crossover method chart. This is going to look at the same 4 indices that I was just looking at here with our previous 2 charts. The difference in this one is it's going to be a lot longer term view. Each of these charts represents 3 years in time as opposed to only 3 months. And every one of the candles that you see on these graphs here are weekly candles as opposed to daily. And so, as you can see, over the last 3 years, it's been a blessing to be long the U.S. stock market. Now, obviously, over the last 3-4 months, it has not been. It has been a rough patch, to say the least. What we've found is that from a 1040 crossover method perspective, and the 1040 that I'm referring to is the 10 period, or in this case, the 10-week moving average versus the 40-week moving average. And as you can see, we've got our labels on the chart to help you kind of distinguish that yourself, but just to make sure we formalize it here, the orange line that you're looking at on these charts is the 10-week moving average. The blue line that we have on these charts is the 40-week moving average. So the 10-week moving average will be more sensitive because it's tracking less time. And so what we're looking for are crossovers of the more sensitive line, the orange line, through the less sensitive line, the blue line. In this particular juncture that we find ourselves in, we found that the most recent crossover that has been achieved has been a bearish crossover. Some of you might refer to it as a death cross, as we've seen the orange lines come down below these blue lines in all 4 of these charts cases. Now that's happened here over the last couple of months, depending on the indice. So from a longer term view, we remain somewhat bearish. From an intermediate term point of view, which we covered here just a moment ago, that's where there's a little bit more element of bullishness coming through. So, we'll see if that leads to ultimately reversing course on some of these longer term indicators. What we've seen over the last 3 weeks is a positive start towards that, although not a guarantee. You can see that the last 3 weeks we've had nice upward trajectory in the candles themselves, but we've got a lot of work to do to have those moving averages start to turn around and go higher again, because they are lagging by nature. So across the board, bearish crossovers on all 4 of those indices. Let's now take a look at some of the 12 grid analysis out there, starting with chart 4E. And as a reminder, when we're pulling this one up, the background color of the chart will determine whether we have a bullish or bearish intermediate term posture using that market forecast technical indicator. So as an example, when we look at the 10-year treasury yield up here, and it's got a pink background, that means that according to that intermediate term line, which is at 15 right now, remember anything below 20 on that market forecast indicator would be considered bearish. So that is considered bearish. And then on the flip side of that, no surprise, TLT, the US government bonds themselves, are actually in a bullish move. Notice that that intermediate line is at 86.09. And although it's falling, it doesn't matter, because as long as it's above 80, we consider it to be bullish. So that makes sense considering US government bonds. Prices and yields typically move inversely to one another. So usually when you see TNX falling, you do see TLT rising, and vice versa. So as we look at this particular 12 grid here, I'm just trying to look for some of the outsized moves that may have taken place and just kind of recognize what sort of trends are intact here currently. So today what we did see is that the crude oil contract did reasonably well. Notice that crude oil was up 2.6% today. And where we find ourselves now is not only a bullish intermediate term posture using the market forecast indicator, but for the first time in basically, let's call it 2.5 months, we actually closed above the 30-day moving average. Notice that it would have gone all the way back to this candle back here on probably August 16th was the last time that /CL, the futures contracts for crude oil, closed above that moving average. Now, again, we've got work to do, right? The technical analysis theory is that when you've been in a downtrend and then you attempt to bottom and go higher, there's going to be a lot of resistance along the way. But if there is a bottom that is going to occur, eventually price has to go above a moving average, and that's where we find ourselves right now. So whether that continues to go up at a rapid pace or whether this is just the start of that bottoming process, we'll soon find out. But it is a good sign that it's at least at this point stopped falling. Remember, crude oil is oftentimes viewed as a proxy for the strength of the worldwide economy. If crude oil prices are strong, it generally is perceived that oil is in demand because the economic engine of the world is humming at a brisk pace. What we do find over here with gold is that gold is also having a bullish posture right now, according to the intermediate term line on the market forecast. But you'll notice that gold was actually down today. So a little bit interesting there. But remember that traders often view gold as a little bit different than crude oil. Crude oil is known as more of a barometer for what's happening economically as a commodity, whereas gold, the commodity, is oftentimes viewed as a store of value and almost a place to hide out if there is chaos around the world, either geopolitically or economically. So we have had some really nice price action out of gold, and I think that there is still room to the upside since it has kind of sat out the rally over recent years. But today was a rare day where it decided to take a little bit of a breather. Nonetheless, it remains in a very significant series of higher highs and higher lows, remains above that rising 30-day moving average, and remains with a bullish intermediate posture. Let's take a look at our next set of 12 grids now, which will be chart 4F. For those of you that are premium market scholars following along at home, this is going to be our foreign stock markets 12 grid here, and we've got good news to share. It's a clean sweep for the bulls. As you can see, all of these 12 charts have that green background color, telling us that from the intermediate term perspective on the market forecast, we do have bullish postures. Now, obviously, you don't just want to blindly go out there and grab every single green chart that you see. You're going to also want to, use your other technical analysis skills to try to determine where do you see opportunities. So, as an example, when we look at these charts, Mexico looks kind of interesting. We've been talking about that one a lot in recent months. Obviously, the wall, building the wall has been front and center of a lot of mindsets of traders out there. And of course, that is the wall that I'm referring to for those of you that might not be in North America, where it's a little bit more prevalent, where we hear these conversations. The wall is the wall that is a big controversy here that potentially is going to get built between the United States and Mexico. Well, anyway, Mexico's stock market really fell quite significantly in the fourth quarter of 2018. In fact, it was one of the worst of these 12 on the board over that time period. For a while, it was down well over 20%. Well, you can see things have nicely turned around for Mexico, and this is EWW if you want to pull it up on your own graph. Notice that over the last 3 months, we're still down 11% on EWW, but we've had some very nice price action here recently that suggests that a bottom could very well be forming. The reason I say that is because not only have we formed some higher highs along the way, notice that where we're at right now is clearly higher than this previous high that we saw back here on December 3rd, but we've also got some further evidence here with the color of the moving average itself. Notice that the color of that moving average is green. Notice that for the vast majority of this chart, it was red. Remember, the moving average will turn green on this particular chart setup for F when we have price above a rising moving average, which is oftentimes a precursor to a nice trend that is ultimately going to be formed. Now, again, that doesn't offer any guarantees, but at least we do know one thing factually. The downtrend that was intact for much of the fourth quarter of 2018 is no longer intact. Right now, if anything, we do have more of a shorter-term uptrend that is taking hold here with Mexico. So keep your eyes on that one. Brazil's also quite strong, close to 3-month highs on Brazil. India is also doing quite well, trending higher above that rising moving average. So those are some of your key areas that are exhibiting a little bit more strength than others around the world. Let's take a look now at the US sectors 12 grid, which is chart 4G. As we look at chart 4G here, again, good news, at least if you're bullish. Across the board, we have green charts, again suggesting that according to the market forecast intermediate term line, we do have bullish postures on these various sectors here in the United States. Now, these are the large cap sectors, I should point out. Remember, these are market cap weighted. This all belongs to the sector select spiders category of fund companies out there. But anyway, as we look at this, you'll notice that, again, there are some charts that probably deserve your attention a little bit more than others. One area that's really been kind of interesting to me is the communications. Notice that's chart XLC up here on the top rung of the charts. And notice where we're at is, like a lot of the sectors that we see out there, we had oversold cluster signals. That's what all these little green dots appearing below the candles are representing. Basically, oversold cluster signals according to the market forecast. Notice that was occurring, basically with the vast majority of sectors that weren't named utilities late in December. Well, like most of these other sectors, communications has gone higher. The difference is the amount they've gone higher. Notice that communications has really taken off to the upside, and we are now trading well above that moving average. Notice that in the case of a lot of the other sectors that are out there, whether you're talking about industrials, you're talking about healthcare, you're talking about staples, yeah, you've had your reversion to the mean move there as well, but you remain below a falling moving average. So there seems to be a little bit more resilience here in some of these communications names. To add to that conversation, remember that every Friday night I produce the sector selector over at marketscholars.com. The full version is available for all premium market scholars. The top half of the version is available for free, even for those of you that are not premium members. And so as we look at that last graphic from Friday night, notice one thing that stands out like a sore thumb on this graph right here is that communications went from number 6 ranking to number 2 ranking. Now remember, that was even before today's price action and yesterday's price action. This was produced as of Friday night, January 4th. So we already had kind of a heads up going into this week that communications was exhibiting some interesting strength on a relative basis versus some of these other sectors that are out there. While I'm over here on the internet, just a quick reminder that if you're watching these videos on our website, on the blog area of our website, remember we make it nice and easy for you to engage with us by clicking like on Twitter directly below the graphic. You can also give us a thumbs up on Facebook, and then you can also click like down below on our website itself. That's all we ask of you. We're not charging you for these videos, and it does take a few hours out of our day to produce and edit and send out the notifications and all that fun stuff. So we just want to make sure that those of you that watch these videos get value out of them, and that's how you can let us know. Simple clicks, just like that. All right, back on track to the analysis of the Thinkorswim graphs here. As we look at some of these other areas that are starting to firm up, one other area, actually two other areas that I see right now that also are trading above that moving average are discretionary and materials. And so it's the discretionary area that I wanted to concentrate our trade application example on here today. I kind of hinted at it in the intro of tonight's video as well when I said that the NASDAQ was outperforming and that small cap stocks were outperforming. So put a pin in those two notions and then put a third pin in the notion that you now see discretionary stocks perking up as one of the key sectors above a rising moving average here. So when we combine all three of those philosophies into one, I wanted to show you a stock that I've been kind of monitoring here for quite some time, and I'm kind of kicking myself right now, quite frankly, that we didn't latch onto it earlier because I was noticing strength out of Crocs. Yes, this is the goofy plastic clog company. I'll tell you what, as the parent of a 4-year-old, they actually come in quite handy for little kids. But nonetheless, I digress. As you can see here, this stock, which is just ticker symbol CROX, almost acts as if it didn't know that we've been through a turbulent stock market period. As you can see, this stock has seen a significant series of higher highs and higher lows over the last year. This is a yearly chart. This is a 1-year weekly candle chart. Now today, we surged to new highs for the year. We were up 3% on Crocs, finishing just a hair above $30 per share. Notice that we now have this nice green background color showing up next to the candle as well, reminding us that we have 3 green arrows according to the weekly candle view. So remember that this isn't the daily candle view that we're looking at here, but even on the weekly candle, we have 3 green arrows. We have the green arrow on the moving average because price is above the moving average. We have the green arrow here on the MACD, and we have a more recent green arrow here on stochastics. And so this one has been impressing me as it's continued to rise with a series of higher highs and higher lows, no matter what the stock market has been doing in the last year. Equally as impressive to me is the way that it handles itself around the 30-week moving average. Notice that back here, it kissed that 30-week moving average and bounced off of it. It then came back down and tested it one more time, bounced off of it yet again. So this thing has done a great job of staying clear of the underside of that rising 30-week moving average. So what I thought we would do today in this paper money example of a trend trade is look at a trend trade that has the stop loss below that moving average with the theory that if we're wrong, let's say we buy this right now and the stock immediately starts turning over and starts going lower, at least we can hold out some hope that it might bounce off that moving average like it did back here and like it did back here. So this is kind of the mindset that I have for my top-down trend trading class that I teach over at Market Scholars on Mondays, where we implement the 3 green arrow philosophy using weekly candles. And so what I thought we would do tonight, just to make it nice and simple, is let's just apply a $10 trail stop to the order, because right now, if we buy it at, let's say, $30 or thereabouts, that would put our $10 trail stop initially down here at 20, which is a little bit below where the moving average itself is. Now, because that is such a wide trail stop there, we can't apply a huge position sizing to it. So I'm only going to do 100 shares just to implement the example idea here, which is only going to be a capital outlay of $3,000. And that means that if we were to see this thing immediately go lower, which is not likely, but if that were to happen, we would get stopped out there down by about $20. We would lose about $1,000 on that. Again, we don't want to do that, but you know, if that were to unfold, that is kind of where our risk is in this particular trade. Otherwise, if it continues to trend higher like it has for the last year, we could very well see continued upside success out of Crocs going forward. So let's go ahead and place that trade. I'm just going to right click on the chart here, and I'm going to go to buy custom right here, and then use with stop, which is that middle choice. Once that order loads up down below, again, I'm just going to leave it at the default 100 shares here in paper money. But what I am going to do is I'm going to adjust a couple of things. First of all, it looks like it's just giving me some kind of funky numbers there. So I am going to be comfortable buying this, let's call it $30.25 tomorrow, right? Which gives us a nice 10-cent buffer from where it closed today, just in case it perks up a little bit in the morning. And then on that second line item right there, where it says stop in pink, I'm going to click on that, and I'm going to go to trail stop. To the right of trail stop, I'm going to click on where it says day, and I'm going to choose good till cancel, because otherwise that trail stop would get canceled after the very first day. And of course, we want it protecting ourselves day after day after day. And then on that third and final line item down below there, it puts kind of a default 10-cent trail stop on there. That's not what I want. In fact, I want a $10 trail stop the way that it's currently set up. So I'm just going to adjust it accordingly so that it says minus $10 instead of minus 10 cents. And then I'm going to go over here and just make sure everything else is set up. It looks good to me, so let's confirm and send. Review it one last time. Everything looks good there, so I'll send that one in, and we'll see if we can get filled on that first thing in the morning. All right, well, I want to thank you for joining me here tonight. Always a pleasure to go to work for you. Remember, I do have my strategy lab class coming up tomorrow. David's got some excellent classes coming up throughout the rest of the week as well for those of you that are premium market scholars. So I'll look forward to seeing all of you in those classes, if not the next time I do this market outlook presentation. So with that, have yourself a great rest of the night and best success with your trades and your investments. Goodbye for now.